Working man investor. Today's video is going to be on our current state of our economy and the cracks we're starting to see form. So Friday we got some concerning news about the state of our economy that I'm going to go over. However, the information I'm going to provide to you is based all off of GDP. So I'm going to quickly explain to you what GDP is. If you don't understand what GDP is and how it works, you're not going to understand this video. So GDP stands for Gross Domestic Product. GDP is the total market value of all goods and services produced in an economy in a given time period. In the United States, GDP is reported quarterly. Some examples of goods that are manufactured are cars, smartphones, clothing, food, furniture, houses, computers. Services, think of car repairs, haircuts, doctor's visits. When GDP is growing, when its value increases over a period of time, meaning that the total value of goods and services produced within an economy is higher compared to the previous period. Usually measured as a positive percentage of a growth rate, essentially the economy is producing more goods and services than before. This is quarter one of the new year. If the economy is growing, we're producing at a higher rate than we were fourth quarter last year, which we're not, as we're going to get into. It is contracting when it's producing fewer. The Federal Reserve wants to see GDP growing because that is associated with more jobs and a rising standard of living. A contracting GDP means a potential recession and job loss. Into this information here. Several economic indicators have been raising alarms as consumers and businesses brace for Trump tariffs and the federal jobs cuts that we have going on. The latest and perhaps the most stunning came this past Friday when the Atlanta Fed's GDP Now tracker showed that the first quarter is on track for 1.5% contraction. Only 9 days ago, on the 19th of February, it was pointing to growth for the first quarter. It's supposed to be 2.3%. So according to the Atlanta Fed's GDP tracker, the economy at this current state here for this first quarter, which is January, February, March, our economy is expected to contract, meaning get smaller by 1.5%. What's so concerning about this potentially is just 9 days ago, as of the writing of this article, it was expected to expand by 2.3%. So the Atlanta Fed attributed this sudden change to the U.S. trade deficit, which drags on growth. Trade deficit is obviously we are importing more than we're exporting. We're buying more than we're selling, and that will drag down growth and also very weaker consumer spending. So this past Friday, the trade deficit in goods showed a record of 153.3 billion deficit in January as imports soared by 34.6 billion versus only 3.3 billion uptick in exports. While most of President Donald Trump's tariffs have not gone into effect yet, consumers and businesses have been loading up on imported goods since the election to get ahead of higher prices. The latest report on durable good orders, which saw an increase, may also reflect a rush to buy imports early. So part of the problem why we've had such a big uptick in imports is because businesses are stockpiling raw materials from China, Mexico, Canada, here within the United States to avoid the tariffs for as long as they can. We're also starting to see consumers, so basically our American citizens, getting nervous about tariffs and they're stockpiling things because they're worried about prices going up. So despite the shopping spree on imports, overall demand is weaker. That's key. They're noticing that demand is still weaker despite the fact that people are going out and stockpiling resources. Separate data on Friday showed Americans slashed their spending in January at the fastest pace in 4 years. Unseasonably cold weather was likely a factor, but Trump's policy, including plans to drastically cut federal spending and downsizing the workforce, also may have played a part in it. They don't know that for sure yet. So what you need to understand here is many American citizens, this is the most that they've heard the word tariff in their entire life. And they really don't know what to make of it. There's a lot of misinformation out there. They think when you slap a 10% tariff on products imported from China, that China's government pays a 10% tariffs. They do not. The American business that is manufacturing in China and importing it, they're the ones who pay the tariffs. And why can that make it more expensive? Because businesses will often pass expenses on to the consumer. The other thing that really concerns me is when the consumer is scared, what do consumers stop doing? And when they don't understand things, they stop spending. Consumers have the ability to initiate a recession all by themselves, because you got to remember, our spending is somebody else's income. So when people stop spending their money and stop going out to eat, stop looking for new cars, stop buying products in general, inventory will start to build up. When inventory starts to build up because the consumer is not buying, manufacturing plants begin to lay off because their product isn't selling. They don't need as many workers, they don't need as many shifts, and that leads to a recession. So it's fear-based. Economics is the study of human behavior. And when people get scared, when people don't understand what's going on in the economy, they have a tendency to shut down their spending. And that in itself can trigger a recession. So increased uncertainty surrounding trade, physical, and regulatory policies is casting a shadow over the outlook. Other data also sound the alarm that jobless claims were up last week as cuts by Dodge rippled through the labor market. Pending home sales have hit a record low, which shouldn't surprise anybody where interest rates are at. And the consumer confidence indicator sank on rising fears. And this goes back to what I say. The consumer confidence index is an important thing to watch. If people are confident and excited about the economy and their future, they spend. If they're worried, if they're concerned, they stop spending, they build up their emergency fund, they maybe pay off a credit card. They do things to try to protect themselves financially. And as far as the jobless claims go, that's something that's reported every week. That's always worth watching. If they start ticking it up, you want to compare it I like to compare it like this week to like the last 4 or 5 weeks and see where the trend is at. One thing you need to watch when you do that, and this is just a bit of information here that doesn't really go along with this article, is do you remember, I believe it was last summer, when we had the hurricane rip through Texas and part of the South? Well, when that happened, a lot of people evacuated. When people evacuated, they don't go to work. When that happens, jobless claims can tick up. Sometimes you get some misinformation out there to where jobless claims tick up because of a natural disaster, and people will start screaming that we're headed towards a recession or the economy has some issues. But then these people move back home like they did in Texas after the hurricane and through the South, and they eventually go back to work, and the jobless claims tick back down. So sometimes you'll get a natural disaster that makes jobless claims look worse than what they are because they had to evacuate and their jobs are still waiting for them when they come back to work. Just something to keep an eye on if you start watching for this. Okay, so to be sure, 1 quarter of contraction would not necessarily cause a recession. The unofficial rule of thumb is 2 consecutive quarters where growth goes down. So if we do end up negative 1.3, like this article says, for this first beginning part of the year, that is not a recession. You have to wait till the second quarter where you also have negative GDP, then the Labor Department will often call that a recession. Recessions are often backdated, so they don't call a recession until sometimes even after they've already happened. So we could be into the third quarter of this year showing good growth, and they'll be like, okay, yeah, the first quarter of the year we didn't have the soft landing that everybody's talked about. We slipped into a recession. So he then goes on to say, for now is not the time to hit the panic button. I would agree with that. I'm not putting this article out and this information out to hit anybody with the panic button. It's really just an example of how I watch what's going on in the economy, an example of how you can watch jobless claims and GDP and things like that and try to get an idea of what things are doing moving forward through your life. Then it just goes on to say that Dodge and tariffs combined are mild and temporary shock to the economy that will put modest upward pressure on inflation and modest downward pressure on GDP. I agree with that on Dodge. people there, if they do lose a job, they're eventually should be absorbed by the private industry for a job. They'll find something else. Tariffs, if you've watched any of my other videos, I'm not completely sold on. Usually, American companies, they will pass on extra costs to the consumers. This is why corporate tax cuts are important, whether you're for them or not. So let me just make a case of why I feel they're important, and I'll give you both sides of the story. This isn't to be political. So if you're going to tariff a company for manufacturing in China, Mexico, whatever, and then bringing it back across the border to sell to us, and we hit them with a 25% tariff, and you cut corporate rates, tax rates. So I think corporate tax rates right now are, should have double checked this, I think they're like 28%. Say they cut it down to 18%, they cut 10% off. The theory is that because you've cut corporate tax rates and made these corporations taxes cheaper, that they won't either pass on the tariff to the consumer or they won't pass it on as much. So if there's a 25% tariff and we cut their taxes by 10%, 15%, maybe they either don't pass that 25% on to us or they pass on 10%. Try to lessen the blow to the consumer and to the everyday people that are just trying to make ends meet. Unfortunately, I'm unaware of any law where Congress and the president can give corporate tax cuts and then demand that they don't pass tariff costs on to the consumer. So it's going to be up to the business. I still think they're going to pass it on. Maybe they won't pass all 25% on. The good thing is it's a capitalist economy. Let's say Walmart get past the corporate tax cuts, and Walmart passes all 25% onto us, the tariffs onto us. But Target only passes 10% on. Where is everybody going to go shop? They're all going to go to Target because it's cheaper. This, in theory, forces Walmart to drop their prices more evenly to Target. That's the theory. So that's all I got for you. Working man investor, keep grinding.